Welcome to Banking 101, a first principle jargon-free course on banking. In this lesson, we will learn about investment banking products. This lesson will use many terms that were explained in prior capital markets related lessons. Hence, in case you need to revisit concepts from those lessons, feel free to do so. In a capital raise, on one side, are issuers that raise capital by issuing equity and debt instruments. Issuers could be corporations, governments, and not-for-profit entities. On the other side are the end investors, including individuals and institutional investors. Investment banking products serve issuers while asset management products serve investors. Large investment banks are often referred to as the sell side because they serve issuers, who are selling securities. Professional money managers are often referred to as the buy side, as they serve the investors, who are buying securities. The investment banking industry comprises divisions of full-service banks and pure-play investment banks. Since our course is focused on banking, in this lesson we will cover products of banks engaged in investment banking. Investment banking divisions of large banks are usually organized into three groups: mergers and acquisitions or M&A advisory, capital markets, sales and trading. The first two groups engage in core investment banking functions. The sales and trading group provide brokerage services to institutional investors. In the rest of this lesson, we will deep dive on each one of the three. Put simply, M&A advisory is the provision of advice to either the buyer or seller of a business. The services offered to sellers and buyers are often the same, though from antipodal perspectives. Investment banks advise sellers on the valuation they can expect for selling their stake in the business. The same service is provided to buyers but with the purpose of preventing the buyer from overpaying. Investment banks act as matchmakers between companies who are seeking to acquire businesses in a specific industry and owners seeking to sell. They also pitch the selling company to prospects. They put together data tapes to share with prospective buyers. Due diligence refers to the investigation of a company's financial, management, and operational strength. The M&A teams conduct due diligence on the target business. If the client is the seller, due diligence is done at the time of accepting the seller as a client to avoid representing an undesirable seller. For the buyer, due diligence is conducted after data has been shared by the seller. Investment banks also help the buyer and seller negotiate terms. Finally, the M&A banker may leverage her network to help the buyer find a lender if the buyer needs to finance the acquisition with debt. Consider a family-run business whose owner wants to exit a line of business that manufactures organic dairy products. A ketchup manufacturer wishing to expand into new food categories buys the business. This is the type of transaction the M&A group will facilitate. Consider a different scenario. The owner of the family business wants to raise $50 million to expand into a new country. Capital is raised from 4 investors. One of them is the ketchup manufacturer. Another investor is a high net worth individual. The third investor is a private equity firm. The fourth investor is the asset management arm of an insurance company. In return for $50 million, the 4 investors get a combined stake of 10% in the company. This type of transaction will be handled by the capital markets group of an investment bank. M&A can be thought of one extreme scenario of capital raising where a business is selling a meaningful portion of its equity to another business or the equity ownership of 2 companies is being pooled together in a merged entity. Next, we will learn about capital markets group within investment banking. The capital markets group helps businesses raise capital in the form of equity or debt. A core capability the investment bank brings in providing this service is its ability to link the issuing entity with a global network of institutional principals and professional money managers. Capital can be raised either in the form of equity or debt. Investment banks have separate teams for equity capital markets and debt capital markets. Capital can be raised in the public or private markets. As we learnt earlier, public markets refer to securities that are offered to the general public. In private markets, only qualified investors can invest. The term private placement is used when capital is raised in the private markets. We can distill 4 scenarios of capital raising across 2 dimensions: equity versus debt and public versus private. While the area of capital markets that gets most attention in the press are initial public offerings, investment bankers operate across all 4 quadrants. However, an IPO is a good use case to illustrate what an investment bank does. Let us take the example of the traditional IPO process in the U.S. An issuing company first sells its shares to a syndicate of selected entities called underwriters, at a pre-negotiated discount to the offer price. The underwriters then sell to their institutional and retail clients. 1 or 2 banks among the underwriters is selected as the lead underwriter, who do bulk of the coordination work with the issuer and the syndicate. There can be many underwriters to an IPO. For example, the Facebook IPO had more than 30. Prior to the date of the offering, the underwriters allocate shares to their clients, and if demand exceeds supply, they ration the supply among their clients. Most clients of the underwriting consortium are institutional and high net worth investors. Hence, retail investors struggle to buy at the IPO price. However, some issuers may make an extra effort to include retail investors by appointing retail brokerage firms within the underwriting syndicate. Once the initial allocations are sold to the clients of the underwriters, the shares are free to trade in the stock exchange. Next, we will summarize the role of the investment bank in the IPO. First, the investment bank helps the issuer determine the realistic valuation they can expect for their company. Second, the investment bank facilitates the sale of securities by leveraging its brand reputation with the community of institutional investors and marketing the offering to them via physical and virtual roadshows. Finally, an IPO can be done on a firm commitment or best effort basis. In a firm commitment, the underwriters buy from the issuer at a negotiated discount and resell to their clients. Hence, they absorb the risk of the issue not being fully subscribed at the expected price. In best effort model, the underwriters don't give any such commitment. While we discuss services offered by the capital markets group within the context of an IPO, many of the same services and concepts apply across the four quadrants. However, the manner with which these processes are executed, the type of investors who invest, and the applicable regulations are different across the quadrants. For instance, since the terms of bonds issuance are more complex than terms of equity issuance, investment banks have to facilitate more intense negotiations in debt capital markets over equities. Similarly, disclosure requirements are more stringent in public markets than private markets. If the price of a security crashes after IPO because of some freshly revealed information, the issuer and the investment bank are likely to be sued. Hence, investment banks tend to have specialists in the different areas. So far, we have covered the two investment banking functions. We can now move on to the broker-dealer services of large investment banks. These groups are known as sales and trading desks. The sales and trading team, abbreviated as S&T, is responsible for executing trades for their clients, which include institutional investors and corporates. They are, thus, the institutional equivalent of retail brokerage firms. Before we get into details of what S&T teams do, it is useful to understand what role they perform. In a nutshell, S&T teams help clients manage risk either by acting as matchmaker or absorbing the risk themselves. Next, we will look at an example of each. Consider an oil explorer in India and an airline company in the US. The oil explorer is worried that the price of oil will fall from 100 to 90. The airline company is worried that the price of oil will increase from 100 to 110, raising its input cost. The S&T intermediates a derivatives contract between the two at a price per barrel that protects the oil explorer from a fall in price and the airline company from an increase. Consider the following scenario. An institutional investor wants to sell a large volume of bonds in a company. But there are not many willing buyers at that time because investor sentiment has soured on the bond issuing company. The S&T desk buys the bonds from the investor using the investment bank's own money with the intent to sell the securities at a higher price later. The clients of S&T are different from the other two teams that roll under investment banking. The clients of the other teams are operating entities, business and governments, which participate in the primary market for capital. The client of S&T teams, on the other hand, are mostly professional money managers who act as agents of investors or institutional investors like insurance companies and pension funds that act on a principal basis. Corporate and government-owned operating entities also use S&T teams for executing derivatives trades to manage risk and buy forex. The traders within S&T also execute trades emerging from the work of the other two teams. For example, the S&T team may execute the trades for an IPO, thus completing a process that was initiated by the capital markets teams. Since the sales and trading teams are often trading in public markets, they are not allowed to have information, which is not accessible to other investors. Hence S&T teams are ring-fenced from M&A and capital markets teams. The S&T team is further organized into sales, trading and research. The sales teams manages relationship with clients and pitch trading ideas to them, based on proprietary research. They are typically organized by the customer segment. For instance, some salespeople could be focused on hedge funds, others on principal intermediaries like insurance companies and others on corporate customers. Next, if the sales team is successful in getting a client to place a buy or sell order, the traders execute the orders. The traders are organized in two broad clusters, equities and FIC. FIC stands for fixed income, currencies and commodities and refers to the sub-asset class in which a trader specializes. Finally, the research teams produce proprietary industry research and investment ideas that are pitched to clients, either directly by them or through the sales teams. Next, we will dig deeper into the role of traders within S&T. Given the complexity of capital markets, the trading teams specialize by the asset class in which they trade. The equities team trade shares and derivatives linked to equities. FIC stands for fixed income, currency and commodities. We encountered the term fixed income in a previous lesson, where we said that the term fixed income refers to various forms of debt, since cash flows derived from debt are relatively fixed, at least as compared to equity. Within the FIC teams, traders have further specializations. Rates refers to interest rate derivatives. If a client wants to hedge against interest rate risk, the sales team will direct the trade to this team. Credit teams specialize in trading in bonds and syndicated loans. In a previous lesson, we shared an illustration of a mortgage originator selling securities backed against such loans. Such sales would be routed through a specialist securitization team, which specializes in selling debt instruments that are backed by cash flows from other financial assets. Currency traders buy and sell currencies as well as derivatives linked to currencies. Currency traders can also specialize by currency. Commodity traders trade commodity-linked derivatives and not the physical commodities themselves. They specialized by commodities, for example precious metals, agricultural products etc. In the lesson on asset management, we learnt that broker-dealers can fulfill client orders across multiple execution venues. The same apply here as the S&T Group is an institution-focused brokerage. First, they can route the order to an exchange. The fees charged for such routine trades are low. Some brokers offer direct access, where the client uses a digital platform to route the order to the exchange they want. Second, the broker can route the order to a digital trading platform. We previously learned about these platforms in the trade lifecycle lesson. As some of these platforms build advanced capabilities, the distinctions between them and exchanges get blurred. Finally, the broker-dealer can execute the trade through a traditional voice-based OTC transaction. Prior to the financial crisis of 2008, banks could also engage in proprietary trading, which means trading on one's own behalf for the sake of making profits. However, regulations have since then mostly eliminated such trading. We can summarize the S&T services into four categories. First, they give investment ideas to their institutional clients through proprietary research. Second, they provide best execution when their clients trade, which means getting the best trade terms for their clients. Third, they engage in market making. Finally, they are providing services that facilitate trading, like margin loans and securities lending. Let us quickly look at each one of them. Research teams within S&T generate investment ideas for their buy-side clients. Sell-side research analysts usually specialize by industry and follow companies within that industry. These analysts also publish research reports and buy, sell, hold recommendations on stocks. Research analysts maintain relationships with C-suite executives of the companies they cover. It is expensive for smaller buy-side firms to build their in-house corporate access teams and hence, they can rely on the sell-side research teams to facilitate information gathering from issuers. The research analysts are ring-fenced from M&A and capital markets teams so that they don't have access to private information. Regulators also don't want to see conflict of interest where the research division of the firm is giving favorable coverage in exchange of winning an IPO mandate. In the traditional model, research teams provide investment ideas to their clients for free. In return, the buy-side clients route trades to the trading desk of the firm. The commission buy-side firms pay for trades includes the cost of research. The problem with this soft dollars model is that when a fund manager pays bundled fees, the investors in the fund, who are bearing the expenses, lack visibility on how much they are paying for research versus execution. Regulations in some regions like Europe forced unbundling, making asset managers pay for research separately. In this unbundled model, many asset managers chose to pay for research from their own funds, instead of using their clients' funds. Securities brokerage is the core service offered by the S&T desks. The product is the same as we reviewed in the lesson on asset servicing with the difference that S&T desks serve institutional investors. Best execution is a regulatory standard that requires broker-dealers to get the best terms for their clients. For retail investors, the best execution standard often boils down to price. For institutional clients, the definition of best execution is more nuanced. For example, Best execution for a hedge fund who wants to exit a securities position the same day versus a pension fund with 1 month time horizon for exit would look different. A broker-dealer can bring 3 key best execution capabilities. Next, we will take a brief look at each one. Pricing intelligence is the ability to trade effectively based on a superior knowledge of market prices. This is more relevant in OTC markets because in exchange-traded markets, prices are known to everyone. Another capability is the ability to fulfill large orders, called block orders, without impacting price unfavorably. If a client wants to buy or sell a large number of securities at once, it can have the impact of moving market prices in an unfavorable direction. Hence, the trading desk must optimize between speed and the risk of security prices changing for unrelated reasons if one waits too long. Some brokers also apply algorithms to achieve this balance between these two conflicting imperatives. Institutional investors also increasingly demand proof of best execution through transaction cost analysis. To understand this intuitively, assume that your broker received your order to buy shares at 9 a.m. The price of the share was $100. This is called the arrival price, the prevailing price when the order arrived. The order was executed at 9:05. At that time, the price had increased to $101. Hence, you incurred a notional cost of $1 per share. While actual analysis is far more complex, this example explains the underlying intuition. Market making refers to an entity becoming the buyer or seller of a security for the purpose of facilitating trades. The need for market makers arises because there may not always be an investor available to buy from and sell to. To understand market making, we need to understand the concept of spread. The spread is the economic value from the trade that is captured by the market maker. The market price of a security is the price at which the last trade was executed. This price is transparently available to all on an exchange-traded security. But this is not the price you can actually sell and buy at. The bid price is the price at which an investor is willing to buy and the ask price is the price at which an investor is willing to sell. The spread is the difference. Consider a security whose market price is 100. If you sell, you will only get 99, which is the bid price in this case. A market maker buys at 99 but immediately sells at the ask price of 101, pocketing $2. The market maker quotes an ask price at which she is willing to sell securities and a bid price at which she is willing to buy. The market maker is providing a service by always willing to buy securities so that investors can cash out. But she is also assuming risk that the price of securities may fall after she buys and she will have to sell at a loss. The spread, thus, compensates the market maker for assuming risk. Who are the market makers for securities? First, full-service broker-dealers, the primary subject of this lesson. Market making is embedded into the service they are offering their clients. Second, there are firms that make markets as part of their trading strategy like Citadel Securities. Some of these firms are designated by stock exchanges to be the official market maker to ensure that there will always a counterparty available for anyone seeking to buy or sell. We now know that the spread represents the economic value captured by the market maker. But what determines the spread? Consider shares of two companies X and Y, which are both traded OTC. The shares of company X trade almost daily. The dealer thinks she can sell the shares for $100 within 2 days of buying the shares. The dealer sets a bid price of 99 and an ask price of 100. The spread is $1. Company Y trades much less frequently and the price is also very volatile. The dealer believes she can sell the shares for $100 within 30 days of buying, but a lot can happen in 30 days. So, she quotes a bid price of 90, so that even if the market price fell significantly, she can still make a profit. The spread here is $10. From the previous example, we can infer that higher the risk of holding the securities, higher the spread. Securities that are traded infrequently or have high price volatility will have higher risk associated with them and hence higher spreads. While spread has a positive correlation with risk, it has a negative correlation with price transparency. For example, used car dealers earn profits by buying cars at a much lower price than they are selling. This is partly because those who are selling their used cars to the dealer do not know the most recent market price of the closest match of their car. The exchange is the best market maker as it connects existing buyers and sellers electronically. For heavily exchange-traded securities, like the shares of Apple, the spread is very low, in pennies or fractions of pennies. The reason is that, for such securities, there is almost always someone ready to buy and sell at a price close to the last market price, which itself is known to everyone. Hence, a market maker cannot charge a premium for offering the other side of a trade. In OTC markets, securities trade less often and there is less price transparency. Hence spreads are higher. However, the replacement of voice-based quotes with digital trading platforms are exerting downward pressure on spreads even here. We will next see an example of market making in exchange-traded securities and OTC. The exchange-traded example relates to a practice called payment for order flow. The OTC example relates to bonds. For an exchange-traded security, we would expect the broker to route the order to an exchange. In payments for order flow, a third-party market maker pays the broker-dealer to route the order to it, and it is this entity that routes the order to the exchange. The market maker executes buy orders at lower prices than sale orders. Even though the profit earned on an individual trade is in the pennies, the market maker can make substantial profits by processing millions of trades. In this scenario, the market maker may be holding securities for seconds or minutes. Additionally, if the market maker has inventory of the security, it need not route the trade to an exchange at all and can fulfill the trade in-house. While this example illustrates what a standalone market maker does, our next illustration relating to OTC traded bonds is more reflective of what S&T teams, the subject of this lesson, do. A pension fund client of S&T desk submits an order sell 10,000 bonds of an automobile company. Each bond has a face value of $1,000 and carries a coupon of 5%. The trader, on receiving the order, logs on to a bond trading platform and determines that there is no one buying bonds for that company. Next, she determines that the bonds of a similar company and similar lot size sold a couple of days earlier at 99% of face value. The trader executes the trade with the pension fund, buying at 98% of face value, giving herself a margin of safety. She believes a seller will turn up in a couple of weeks. She is concerned that interest rates may go up soon. If that happens, the bank will be holding a bond for a period of time where the interest rate on the bond is lower than the prevailing market interest rate. So, she asks her colleague on the rates trading team to buy an interest rate derivative to cover her original trade. She also believes there is a small chance that the automobile company would default on its debt. So, she asks another colleague on the credit trading team to buy a credit default swap that acts like an insurance policy against credit default. A week later, the trader is able to sell the bonds to another dealer at 101% of its face value, making a 3% profit on her exposure. She also directs the unwinding of the rates and credit default swap derivative. As we can see in this example, the trading desk of the investment bank is providing a more sophisticated service than simply matching buyers with sellers. In the earlier lesson on trade lifecycle, we had learnt that there is a continuum between voice-based OTC trades and exchanges with digital trading platforms of varying levels of sophistication between them. As we move from left to right on the continuum, the broker-dealer becomes a matchmaker than a market maker. If the broker-dealer is merely matching its clients with sellers, it is not taking any risk. Though market making remains a significant component of what they do, over time, S&T groups have moved from left to right for a couple of reasons. There are two major reasons for reduced market making by banks. First, the world is moving towards networked marketplaces. For example, we rarely speak to a travel agent anymore when booking travel. Second, the capacity of S&T groups to assume the risks of market making has diminished over time because of regulations. Hence, they prefer to link their clients to other dealers who have inventory, instead of becoming a counterparty themselves. Another major category of services offered by S&T desks is asset servicing. In the previous lesson on asset servicing, we had learned about these functions. Let us quickly recap these services from the perspective of the broker-dealer. Full-service broker-dealers provide custodian services of custody, settlement facilitation and record-keeping through the custodian division of the same bank, though clients may prefer to use a third-party custodian. Full-service broker-dealers provide margin loans. Since the broker often has custody of the underlying securities that its client is buying with a margin loan, it is easy for the broker to transfer the securities to its own account as collateral. Broker-dealers also engage in securities lending. They can either borrow securities from their own clients or from their network and lend them onwards to their clients. S&T groups count among their clients two types of investors: professional money managers like hedge funds and principal intermediaries like insurance companies and pension funds. The second group of investors are potential funding sources for professional money managers. Capital introduction services refers to introducing sources of capital to professional money managers. You may have heard of the term prime brokerage. Prime brokerage refers to a line of business within global investment banks, which caters to the needs of hedge funds. Consider a hedge fund that executes trades through multiple broker-dealers. The reason for having multiple broker-dealers could be differences in execution quality, access to research teams and many other reasons. However, For the purpose of settling the trades are routed to the prime broker. The centralization provides the prime broker with the economies of scale to offer the ancillary services we just discussed in a more efficient manner. As an example, if all the securities are under the custody of one broker, it is easier to make margin loans against these securities as collateral. A hedge fund making short sales of multiple securities can go to one prime broker, who in turn borrows securities to deliver on settlement date, on behalf of the hedge fund client. We are now at the end of this lesson on investment banking. We are also at the end of reviewing the 4 lines of banking products, namely consumer banking, wholesale banking, asset management, and investment banking. The next lesson is a short lesson where we will synthesize our learnings across the 4 product lines. But before that, please review the summing up section of this lesson. I will see you shortly, on the other side.